Well, hi and welcome and hooday. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors, and I'm joined today by Doug Johnson, who's our Senior Investment Strategist, and Dan Rinck, who's a Research Analyst with HCM Wealth Advisors. Welcome to our webinar. So if you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question, and we will do our best to answer at the end of the webinar and possibly during the webinar. All right, before we get started, I'd like to let everyone know that our coat drive ends soon, specifically Monday, January 30th. That's this Monday. So please stop by, drop off a coat, give a hooday cheer. All donations are to St. Vincent de Paul Coat Drive. Again, the coat drive ends this Monday, January 30th. We have barrels in our lobby for coat drop off. All right, onward. And I think onward, guys, is a term that almost everybody feels after a challenging year in both stocks and the bond market. Inflation and Federal Reserve, they're very much the focus last year in 2022, and that's going to continue to be an important focus for the year this year. But look for more of a focus on earnings and employment in 2023. Those were both areas of strength last year. That'll be a primary focus this year. And the question I think many people continue to have on their minds is the economy head for recession or soft landing? Well, we're going to look at clues today in the economic data. And I mentioned earnings. Well, what does it mean for stocks if we did see a cut in earnings? We'll have a brief review of 2022 and then onward. So Doug, how about a brief review of 2022?
Sure. So, we had Bruce Springsteen there at the end singing about the glory days. I don't know about you, but the last few days have kind of felt like the glory days of the market. Everything seems to be up, and hopefully we're putting 2022 in the rearview mirror. But what I wanted to do is take a few slides here to do a quick recap of what we saw in 2022, and more some of the nuanced points that people might have missed, but I think there was some really interesting things that happened last year. So just to start, we had inflation reaching an annual rate of 7%, and that was at the beginning of the year. And oh, by the way, the Fed funds rate was at 0. Okay. So now, that seems like so far away because, the Fed has come a long way trying to tackle inflation, trying to be tough on inflation. But we started the year with an inflation rate of 7% and a Fed funds rate of 0%. That to me is absolutely incredible. So what happened? Assets began to realize that the Fed is way behind the curve, and they, essentially begin to reprice based on higher rates. So we saw everything kind of going down in unison, but growth assets, or ones that are priced off of interest rates and have more sensitivity to those rates, were down much further than the normal market or things like value. So the Fed eventually becomes ultra aggressive in their quest to catch up with inflation. They raise rates 4% over a period of 10 months. And as I mentioned before, the sectors that benefited from years of low rates and high liquidity significantly underperformed. You had value and dividends as the best performers, and then you had bonds suffering their worst year since 1994. Speaking of the Fed, this, I think, falls under the camp of, Fed credibility, Fed uncredibility, but this was actually said under these conditions. So on May 4th, 2022, with an annual CPI of 8.26% and the Fed funds rate at this point at 0.83%, Fed Jay Powell made this comment in a Fed meeting, and I quote, "A 75 basis point increase is not something that the committee is actively considering." What happened from that point? The Fed would go on to raise rates 75 basis points each at their next 4 meetings. So as we look back on 2022, and it's always easy to look in the rearview mirror and say, wow, I can't believe we missed this, or I can't believe we missed that. It was so obvious. Well, at the time you had the man who was, charged with making the decision around the rate that is supposedly supposed to help control inflation, saying that they weren't considering being so aggressive, and then they turn around and do exactly the opposite. So, for most of 2022, it was a relearning process for a lot of people in terms of trying to gauge markets that had high inflation and rising rates. So, Dan, can you give us some context around some full year numbers, both in terms of what the equity market did and then what the bond market did?
Yeah, absolutely. So we're just going to do a quick little recap of 2022, what the best performers were, what the worst performers were on a relative basis. You see on this chart, we have the S&P 500, we have the Russell 1000 growth, we have the Russell 1000 value, which is more dividend focused. We have the Spider MSCI ACWI, which is our international ETF, and then the iShares Russell 2000, which covers small caps. As you can see, that purple line, that's the S&P 500. So that's the main index that is tracked. It got down to as low as 24% at one point throughout the year, finished at about -18. But the main themes in 2022 were definitely focused on dividends and value being the outperformers. So that blue line there, that is value, the more dividend paying stocks, the quality stocks, that ended down 7.54%. Small cap stocks, which are pretty sensitive to recessionary worries, down the 20.48%. And then you had the large growth stocks, which are the Teslas, the Apples, the Amazons, finishing down, 29% on the year. And then in green, if you notice there, that is our international index. So throughout most of the year, it tracked pretty well with the S&P 500, falling pretty much in lockstep with it. But then in Q4 of 2022, once the Fed was guiding towards slowing their rate hiking in the first half of 2023, international started picking up a little bit. So it rallied towards the end of the year, finishing down roughly 15%. So that's pretty much the equity picture for 2022.
So Dan, I don't mean to interrupt you, but
go ahead.
I want to clarify something. So what you're saying is international stocks outperformed U.S. stocks last
year? They did. They did in 2022.
Unbelievable.
So that was the picture for the equity markets. Now we're going to take a look at the bond market. The bond market was very, very tough in 2022 in the face of the Fed raising interest rates at a pretty historic clip. On this chart, we have the iShares US Ag, which is pretty much an encapsulating index of the US bond market. We have the Schwab Value Advantage Money Market Fund, we have high yield, we have municipal bonds, and then we have investment grade corporates. So as you can see, it was a very tough year for bonds. The benchmark, essentially the aggregate bond, got to as low as 16%, 16.5% down in a year. And those are bonds. Corporate bonds, even worse, down close to 24%. So it was a very, very tough year for bonds. Munis fared a little bit better than the overall ag. And then you have the money market, which no one's really used for a very long time because it was yielding 0.01%, is started to look very, very good in 2022. The yields were rising as the Fed was raising rates, and right now it's paying over 4% risk-free, relatively risk-free compared to the other bond indexes. So it's a very good place to have your cash right now, and we're really enjoying collecting that 4% plus interest. So as we saw, equities and bonds were down in 2022, and we really just wanted to paint the picture of how rare this is. And I had to check this data because I was like, that can't be right, but it's only happened 3 times in the history or since 1928. So 1931, you had the Great Depression. 1941, you had the start of World War II, and then 1969. And even with these numbers, the Great Depression stocks were down 43%, which is really terrible. The bonds down 2.6%. 2% in 1941, 5% in 1969. I think we would have killed to be down 5% in 2022. So to have the S&P 500 be down and bonds down as much as they were, it was a very, very historical year.
Yeah, and I think this may be the only year that we've had since the 20s where you've had both of these returns in double-digit negative.
Double digits,
territory.
yeah.
Yeah.
Yep.
So yeah, definitely an outlier for sure.
Yeah. So looking at 2023 now, this chart shows the S&P 500. The last 4 times, so the only 4 times over the last 90 years in which the S&P 500 had a worse year than this past year. Again, you have the Great Depression, 1974. The tech bubble and the great financial crisis. And you can see the dark blue line is the drawdown. And then the lighter blue line is the following year performance of the S&P 500. So, 1937, you were down 38%. The next year, you're up 24. 74 down 29, up 31. 2002 down 23, up 26. Even the great financial crisis down 38.5%. Next year, you're up 29.5. So typically when you have these really bad markets, you can not expect, but you will run into situations where you see some pretty big rallies in the next year. So hopefully 2023 fares a little bit better from the equity standpoint. So now we're going to jump into what's currently happening in 2023. So in 2022, it was really dominated by value, dividend growers, quality companies, and even international towards the end of the year. So far this year, that script has flipped just a little bit. You're starting to see small caps, which is that magenta color, up 7.51. You're seeing the Spider MSCI ACWI, which is the international stocks, up 9% so far year to date. I mean, we're 26 days in. And then from the US equity side, the large equity side, you're seeing growth starting to lead. So you're starting to see some of these more tech companies, Amazon, Apple's, they're starting to bounce a little bit. And then, we're still positive across the value spectrum. The S&P 500 is still up 4.69, but it's starting off a little bit different than it was for all of 2022. Yeah. So one of the main things that is a concern in 2023 is corporate earnings. A lot of people are worried that with the Fed holding their interest rates as high as they are, and their plan to hold them higher for longer, it might affect corporate earnings. And as Casey kind of led into earlier, corporate earnings falling doesn't necessarily mean that stock prices are falling. So this chart essentially shows a dot plot of situations in which earnings have fallen, but the S&P 500 is still positive. So on this chart, the bottom, the horizontal axis is the 12-month trailing year-over-year earnings per share. And the vertical axis is the S&P 500 price performance. So as you can see in that upper left quadrant, which could potentially be 2023, you have a scenario in which earnings are falling, but the total return price of the S&P 500 is still positive. So bad earnings falling might not necessarily be a bad thing for the S&P 500 in 2023. So, and we also want to take a little bit look at a technical analysis of the S&P 500 right now. So this chart goes back about a year and a half, which covers pretty much this whole market cycle that encapsulated all of 2022. As you can see, there's a very dark black trend line that has emerged. We the price would go up, touch this trend line, and it would be an almost immediate reversal every single time. Very aggressive reversals off this very respected resistance line and trend line. But recently, over the last few days, we actually, for the first time in this whole entire cycle, broke above this trend line, which to me is a very, very positive sign that the environment is shifting a little bit. Another thing to pay attention on this chart is the moving averages. So we have the 200-day moving average, we have the 100-day moving average, and the 50-day moving average. And the moving averages are just trend lines that try to give you an idea of what price has been doing over the last 50 days, 100 days, and 200 days. As you can see in the bottom right there, the stock price of the S&P 500, the index price, is above all three of those moving averages, which is a positive sign. And you're also starting to see the slope of these moving averages move up. In an ideal environment, you want all three of those averages sloping upwards, and you want the stock price to be above it. So right now we're in a situation where we could potentially be looking at a breakout from this downtrend, and we are holding above the moving averages, which can act as a pretty strong support. So 2023 is off to a very good start, I'd say, so far.
I like it, Dan. Again, onward, upward. So now let's focus a little bit on economic data. So the labor market continues to be strong. I mean, I think that's the best word, and it's going to be a focus in 2023. So when you look at this chart, the unemployment rate right now is below 4%. It's right around 3.5%, which is not anywhere close to recessionary numbers. There have been headlines in recent months about some of the larger tech companies laying off employees, tech worker layoffs. They're not historically a leading indicator for deterioration in the overall market. So when you look at terms of the labor market with the workforce, with tech and information sector, it's actually less than 3%. So those layoffs, they've not made much of a dent in the labor force. Now, where do you look for early signs of trouble in the labor market? It's going to be on this slide right here, initial weekly unemployment claims. It's one of the 10 indicators comprising the leading economic indicator report, which we're going to touch on later. But you know what? No trouble yet for the labor market as measured by initial weekly unemployment claims. Just this morning, it was reported that less than 200,000 had filed. That's back-to-back months of claims below the 200,000 level. So overall, the employment picture is strong. It's not indicative of a recession currently.
Yeah, and especially if you look at the recessionary bars on both the chart we just saw and this one, you can see a very distinct pattern where these unemployment claims and the unemployment rate will shift up in a pretty dramatic way. So not only are we kind of historically low levels, we have not seen any movements at all indicating that the current data, at least in the labor market, is showing any recession signs. So when we talk about what constitutes a soft landing for the economy, I think the combination of strong employment, decent earnings, and inflation that's moving down, that's going to give the Fed some wiggle room here in order to not have to continue to raise rates aggressively, is going to be what we would say is a soft landing. So we just touched on the employment side of things. Now let's look at earnings for a minute here. So I know this chart's a little bit busy. I would ask that everyone ignores the orange portion here and more or less focuses on the blue / maybe purple line here. So this is the S&P going back to the mid 60s, and it denotes each time frame as either a hard landing or a soft landing. And in most of these instances, the hard landing situations deal pretty significant market drawdowns, quite frankly, not unlike the one that we just saw. But I think the big difference between what this chart constitutes as the difference between a soft and a hard landing is this earnings growth and the actual percentage number dipping below zero and then turning into a negative number. So if you look at some of the worst periods on here, so we'll just start with 1970, And you take this all the way across, you're looking at an earnings contraction of close to 10%, again in 74, in the 80s, maybe a little bit further than that. And then we see our first instance of what they call a soft landing. You have earnings contraction, but the line remains right around zero. 2000 tech bubble, again, significant earnings contraction, great financial crisis, significant earnings contraction, COVID, significant earnings contraction. But again, when we look at other periods of soft landings, you don't have that earnings growth dropping below that line. So what's happening right now on the earnings front? And before we jump to that, so here's a little bit of a different way to look at this. So you've got years where earnings growth are really negative and you've got really bad S&P returns. So you've got great financial crisis, down 40% in earnings, down 30% in price. Again, tech bubble down 31%, down 12. But as Dan touched on before, even in instances where you have negative earnings, it doesn't necessarily, guarantee that you're going to have a negative market. And you can see in some of these other instances, you've had earnings growth of 10% or less, and you've had positive market experiences through some of these. Some of these you've had flat market experiences. But I think it varies from time frame to time frame. So I think the takeaway here is that you're probably going to hear a lot about earnings contractions coming up. And I don't necessarily think that that's a death sentence for the market. It doesn't mean it's not, but I think we need to interpret that data with an open mind before we declare either victory or defeat against economic turmoil. So looking at kind of where we've come from over the past, we'll call it two years. So here are the earnings estimates and growth going all the way back to January for the S&P 500. So you had a 16% earnings growth annualized right into the middle of 2022. And now we've seen a little bit of a drawdown here of 7.5% coming into this year. Now we're right in the heart of earnings season. So these numbers could continue to come down. They could flatten, they could come up. But if you put these two together, we're still in positive territory. So again, before we write off earnings and say, oh, there's going to be a huge contraction, there's a massive recession coming, you got to batten down the hatches a little bit. That's kind of the Wall Street consensus right now. And as we've seen in 2023, the market is kind of ignoring that right now. Now we'll find out whether that's the market's own demise or whether they know something that some of these strategists don't. But right now we're going to find out more about earnings over the next few weeks. But I think while the information is not as encouraging as it could be, it's also not as dire, I think, as some have expected it to be so far. And then when we look at other data points historically that have either confirmed or denied recessions, high yield credit spreads are one area that we've paid attention to internally for a while and looked at and said, this is one area that's definitely saying that probably not seeing a recession. So why high yield credit spreads over investment grade or something else? High yield is kind of the junkier area of the market. So if you have an economic slowdown or you've got conditions that are tightening across the economy, it's going to show up in areas where you have, more questionable companies trying to borrow money. Those rates are going to go higher. The demand for return to lending to those companies is going to go up naturally. So you can see here that in the past, we've seen those significant spikes up during times of stress in the market. So again, tech bubble, you had high yield spreads getting close to 10%. In the great financial crisis, you had them close to 20. And then even in these kind of, micro market drawdowns, you had them, 7.5%, 8%, 10% here. We haven't even gotten north of the 5.5 mark or 5.25%. That is the 20-year average here. So if we look at the credit market, which some people consider to be kind of the plumbing of the economy, so to speak, high yield credit market is not necessarily telling us that there is imminent danger on the horizon. Now, there are some areas of the market that are certainly saying that there is imminent danger in the market. So, Casey, you want to fill us in on some of those?
Yeah, so this is a little counter, Doug, to the slide that you had, and is indicating maybe a risk of a recession. And that's when you look at the percent of yield curves inverted, and you look at that far right line, and more than 80% of the yield curves currently are inverted. And when you talk about a yield curve, an example of a yield curve inversion is comparing, let's say, the 10-year treasury to the 3-month treasury. Well, guess which one is paying a higher interest rate? Right now, it's the shorter one. The 3-month treasury is paying over 4%, and the 10-year treasury will pay you right around 3.5%. And you're seeing that in many different areas of the yield curve. And some people look and say, well, why would long-term investors settle for lower rewards than short-term investors who are assuming less risk? Well, the answer might be when long-term investors believe that this is their last chance to lock in current rates before they fall even lower, they become slightly less demanding of lenders. And as you might expect, since lower interest rates generally mean slower economic growth, an inverted yield curve is often taken as a sign that the economy may stagnate. It may mean that because yield curves are so rare, investors, it may be the look of a potential recession or slowdown. So, rates may come lower. We don't know what's going to happen in the coming months, but based on history, unfortunately, Doug, this check mark goes in the recession column.
Yeah. And one other thing to point out here is that in some of these instances, the recession bars are happening while these inversions are taking place. But for the most part, the actual recession doesn't take place until after the inversions have kind of disappeared. So, if you're looking at this chart and you're saying, oh, well, here are the inversions, we haven't had the recession, maybe we're safe. Well, it doesn't necessarily work that way.
And as we look at this slide, you see it says LEI. It's referring to the leading economic index, and that's published monthly by the Conference Board. And it's been in a rapid descent now over the past 10 months. So rapid, as you can see here, it's fallen to a reading only seen historically during recessions that were already underway. So we mentioned jobless claims earlier, which is one of the 10 components of this LEI, and it's positive. We also just covered yield curve, which is another component. Now that's negative. The S&P 500 is also part of those 10 components of the leading economic indicators. And back a couple months ago when we had a webinar, we briefly reviewed the 10 leading economic indicators, their status. We looked at the current level, the trend, and we're focusing more on the trend at the time of an indicator of where things might be headed. And the trend of the 10 indicators at that time, back in November, was 7 were worsening and 3 were what we would call stable. As expected, those leading economic indicators, they've worsened. That line has gone down more. And if conditions continue to deteriorate, you would expect, though, that you're going to start to see that bleed over on the strong labor market. And we'll see. Now, we're looking at different areas, some strength, some are showing risk of a recession. I think something that we've got to keep in mind and remember when you're looking at these different recession risks, while they are elevated, if you look at the consumer is still coming from a very strong financial position. Unemployed people are getting jobs. Those people with jobs are getting raises, and many still have excess savings to tap into. So let's take a look at the strong spending data. It confirms financial resilience. It's too early, I think, right now still to sound the alarm that we're headed directly for a recession. And at this point, any downturn that we may see, hopefully that means because of the financial health of consumers and businesses, hopefully that will be limited.
Yeah. And one of the main reasons for all this recession talk is the idea that the Fed has raised rates in order to combat inflation. And one of the ways they can do that is to quell demand by essentially increasing the cost of money, slowing borrowing, slowing business activity. And you go back to the slide that I had at the beginning, where Chair Powell basically comes out and says, hey, we're not really even thinking about doing this. And then he does it 4 times. In the same vein right now, they're telling people, hey, we're going to keep rates higher for longer. We may have some rate hikes still to go in order to combat inflation. And we're going to stick with that path until, in his words, the job's done. So, you've got what he's saying, and then you've got the market, which is almost saying, hey, we don't believe you. The white line here is the actual Fed funds rate. So currently right around 4.5, projected to get right around 5% before all is said and done over the next few months. But then you look at these colored lines, and basically these are all market implied rates or forecasts of what that Fed funds rate is going to look like going forward. So just some highlights here. The consensus forecast taken 2 weeks ago has that number down to 3% by 2025. You've got the break-even forecast at 3.25. You've got the Fed forecast from September down here. So the question then becomes, what is going to cause the Fed off of a position where they're basically coming out each week and saying, hey, we don't think we're going to cut rates. Where are those rate cuts coming from? And I think that's a little bit of, when we're talking about things that are supporting or denying recessionary conditions, I would say this is one area where I think you could say the market, if it's not saying recession, it's saying that there's going to be an economic slowdown at some point. And once that happens and the Fed realizes that they might have over tightened, they're going to have to continue to pull some rates back. But at the same time, this disconnect here can cause some volatility in the market going forward. If everybody's expecting the Fed to cut 200 basis points and they come out and say, we're going to take the Fed funds rate to 5.25 and we're going to leave it there for the entire year, there's got to be some reconciliation here. Just like there was reconciliation from the beginning of 2022, where inflation was 7 and the Fed funds rate was 0, and the market was pricing everything off of Fed's projection of rates at 2.5. So I think one of the big themes of 2023 is it going to look like 2022 in the sense that you're going to have fixed income returns in the double digit negatives and big down equity returns? I hope not. I don't think that's going to happen. But there's certainly still some things that needed to be worked out, over the course of the year, and it may take some time to get there.
Hey, Doug, before you move on to
Sure.
the next slide, go back to the last one. So one of the questions that someone had sent in was, what do you think is going to happen with interest rates here from the Fed in the next month, but also the next 6 months?
So I think they have probably 25 to 50 basis points, basically 0.5% left to hike. Whether that happens at one meeting, whether it happens over the course of 2 meetings, I don't know that matters a whole lot. But what I think will happen at that point, and we'll look at an inflation chart here in just a second, I think they're going to look at that and say, you know what, this is probably good enough for now. We're going to take a step back and let this kind of continue to flow through the system and see what happens. I think there is some concern on their end that you get a repeat of the 70s where they fought inflation really hard at the beginning, raised rates quickly. It subsided a little bit, but then all of a sudden it shot back up and then they had to catch up with it again. I know they don't want that to happen. But I'm not sure that those regimes are the same thing. And we're going to look at one point why I think that's the case here in a little bit. But again, when we talk about projections for the Fed funds rate, I mean, here's actual rates right now in the market. So you got the 2-year rate in orange, the 10-year rate in purple. We reached high levels back in October, 4.25 on the 10-year, and you had 4.72 on the 2-year. You're looking at, 60 basis points of reduction in the 2-year yield and a subsequent number of right around 60% in the 10-year. So again, you've got an environment where the Fed's saying we're going to keep rates higher for longer and we're going to stick around until this inflation fight is done. And the market's saying, well, we're not going to wait around for you. We're going to go ahead and start bidding rates back down. So again, there's certainly some disbelief in what the Fed says they are going to do with rates coming down. And some of that could be the driver of this recent rally that we've seen where growth has been the outperformer versus value. as again, growth is much more sensitive to rates than the value side. Now, this is the inflation chart that I mentioned earlier here. Excuse me. So this shows the actual CPI year over year, going back all the way to June 21st. So the number then was 5.39. Again, the Fed funds rate was basically zero, got all the way up to as high as 7.87 with the rate being zero. And then the Fed decided, okay, maybe we should do something about this now. So the peak in CPI so far has been 9% in June of 2022 with a Fed funds rate of 1.58. So a pretty big discrepancy there. Now, fast forward to December 2022, you have actual CPI year over year at 6.45. You have the Fed funds rate at 4.33. So these two numbers are converging quite quickly. Now, what's the most interesting thing I think about on this chart is looking at what the projections would be for month over month numbers. If you had 0% month over month inflation, which last month, I believe we actually had -1. If you had that, or even 0.1 or 0.2 for the next 4 or 5 months into, we'll just call it May 23, look at where the inflation rates annually would be at that point. 0%, you'd have a 1.54 annual rate. With a 0.1, you'd have a 2, and with a 0.2, you'd have a 2.56. So I think the Fed is well aware of this. And they're probably looking at this saying, okay, inflation's kind of coming down on its own. And if we just let this glide path happen, we could get inflation right back to where it was pretty quickly. And I think that would be an ideal path kind of for everyone. Now, we've had people talking about supply chain issues and stimulus and all that. Well, guess what? That stuff is unwinding, and it's unwinding quickly. So the blue bar on here is the percentage annual growth of the money supply, or what we call M2. And then the red line here is the annual CPI rate, okay? So one thing to notice on this chart is that money supply growth has been positive every single year going back to the early 80s, all right? So what does that look like? And we'll come back to this chart in just a second. But what does that look like on a cumulative basis? Sorry. Well, it looks like a line that just goes straight up, okay? So during COVID, this percentage jumped a tremendous amount, up to 27%, excuse me, growth in the money supply, a significant number, all right? And unsurprisingly, CPI followed that pretty closely. Now, for the first time, you're seeing M2 or money supply growth go negative. And with it, you're starting to see inflation roll over a little bit. Now, you could argue that, and I have heard people make this argument, well, this is a result of quantitative easing or printing too much money. Well, like I showed you on this chart, the money supply has been growing pretty significantly for a long time. But look at these inflation rates. They've never been, other than the 70s, been close to the number that we're seeing right now. So is the stock or the percentage change more important? Or excuse me, the flow, is that the most important thing, or is the stock, the actual number, the most important thing? I would argue that it's the flow portion of this. And as we've seen M2 spike, and now we're seeing it come back down, you're seeing that being translated into the inflation rate, and the inflation rate is naturally starting to move lower. And I think that could translate to conditions that allow the Fed to back off a little bit and hopefully allow the economy to not fall into some of those recessionary conditions that I think people are so worried about going forward.
Hey, this might be my favorite chart of the presentation. So this is a fantastic chart. It looks at the S&P 500 and it looks at the annual dividends. So as you see with that blue line consistently since the 1970s, that blue line is consistently moving up. And then you see back during the great financial crisis in 08, 09, that line. Certainly dividends did get cut during that type of environment, but then rebounded nicely then thereafter, going up. But you can see even last year that there was a big surge. So the S&P 500 decreased by 18.11% in 2022, but S&P 500 dividends, they grew by just under 11% for last year. And our dividend growth portfolio, so the HCM dividend growth portfolio, saw dividends increase by 12.83% in 2022, well above inflation. So, in the face of a very challenging year, it was great to see dividends, and that's what you count on. So, to quote our founder, Mike Hinghold, financial independence is built on a foundation of lifetime income, of cash flow that is dependable, diversified, and growing faster than inflation, and protected. So, and Mike has said it best over the years. It's so important in retirement. Yes, I think everybody loves to beat the market, but in the end, we need paychecks. We need paychecks that grow faster than inflation, because our real plan and what we're really trying to really get to is the result of making sure that you have financial independence, financial security, and dividend income. Growing cash flow is certainly a wonderful way to do that. Now, the protection part, that refers to our income safety nets. We've talked about those before. Essentially, during the course of this downturn, we planned for that, and those safety nets, it's using a bond ladder so we can protect cash flow for 3 to 5 years, so we don't have to be positioned in a way to have to consider selling stock investments at losses to fund your cash flow needs. But an essential part of the portfolio is a dividend portfolio and growing dividends. So I think that was a great positive to see in last year. So earlier, we were talking about the portfolio, where are the prospects for 2023? Dan reviewed numbers last year in 2022, and in value and dividends were very good, but we've seen growth off to a pretty strong start this year. But growth has been very volatile. When you look at the right-hand side of this chart and you see this blue line and that surge of COVID, and growth stocks really went to the moon for a period of time, only to come falling back down to earth. And where they are in valuations currently, they're still a bit expensive, but as much of a drop as they've had, at times you're going to see these bounces. And at this point in time, even though they've done very well in the first couple of weeks, we don't think that's necessarily an established trend, though, here for the remaining part of the year. You look at value stocks with a multiple of 11.2, certainly they did very, very well versus growth stocks last year. Certainly held their value much better. We continue to favor value over growth. And with interest rates as high as they are, and if they continue to stay high, then valuations matter. And we think if that's going to be the environment, that it continues to make sense to have value stocks, especially during this issue that we're dealing with a potential risk in the economy of a recession. So if conditions change in the course of the year, then certainly we may review those and consider shifting and adding potential growth if it's needed. If we see rates come down dramatically at all, or growth really slows. Growth tends to perform well in a very slow growth environment, but still has very much of a headwind here with high interest rates.
Talking about cheap. So one thing, we saw at the end of 2022 was international starting to, rear its head a little bit. So this chart essentially shows international stocks in relation to the S&P 500 since the great financial crisis, 2008, 2009, the QE period, if you will. If the line is going down, that means the S&P 500 is outperforming. If the line is going up, that means international stocks are outperforming. Again, for the last decade, S&P 500 has been the only place to be. International has been a diversifier. You've been able to find some rebalancing opportunities, but it hasn't really been a place to put money to outperform the S&P 500. But now we're starting to see that trend change a little bit. Obviously, it's been a very long time since international has really done something, but we're seeing some good things right now. So again, this is the jaws of doom here. This is from Charles Schwab, essentially shows how extreme of a period of international underperformance has been. The orange line going up means the United States is outperforming, the orange line going down, or the blue line going up means international is outperforming. And as you can see, since that 2008, the blue line has been going down and down, and that orange line has continued going up, the US stocks. We haven't seen a period this wide deviation since even the 1980s were not even really as significant as this. So you're starting to see this trend reverse a little bit. So we're starting to see a little bit more opportunities in the international space. Another thing that's helping international is the dollar. With this QE environment, low interest rate environment, the dollar has been very strong for the last 10 years. This chart shows the real broad trade weighted US dollar index, which essentially just shows, is the dollar overvalued or undervalued? And as you can see, November 2022, we hit a 2 standard deviation or 2 sigma overvalued period, and it's starting to move back down. And when the dollar goes down, that can always be a tailwind for international stocks, which is something that is definitely starting to play out in the actual equity prices. And then again, if we're talking about cheap, there's not much cheaper than international stocks right now. And we love owning stocks that are cheap, that have positive momentum, and that's starting to become the case. So if we look at that chart there, that shows the relative valuation of international stocks versus the S&P 500. And as you can see, it's essentially as low as it's been since this chart even was from inception. And then if we look at the actual financial measures on the left, this ranks the valuation of international stocks in relation to the S&P 500 on a scale of 1 to 5. 1 meaning it's very cheap compared to US stocks, 5 meaning it's very expensive compared to US stocks. And we are seeing a lot of ones on that chart. Price cash flow, EV to EBITDA, price to sales, price to trailing 10-year earnings per share, forward PE, pretty much every single metric international is as cheap as it can be. So we're not backing the truck up for international right now, but it's definitely something that is really interesting to us. We're seeing it not as much as a diversifier anymore, but a place that we could put money to outperform the S&P 500.
Yeah, and I think another point is that these conditions have existed for a while, quite frankly, from the valuation side. What we haven't seen is the price movement.
Yep.
And that's really taken place over the past 3 months. As I was joking earlier, I made Dan repeat himself and point out that yes, international stocks did outperform the S&P 500 last year, and most of that gain took place in the last 2 to 3 months of the year. So, for all of the issues that I think people have worried about outside of the U.S., specifically situation in Europe with the Ukraine conflict, and then with China being such a large part of the emerging market universe, I think what initially started, and to be honest, is still ongoing. I think the worst case scenarios that everyone was concerned about going into that have subsided a little bit, and I think people have taken a step back and looked at some of these companies and said, hey, these things are dirt cheap. And there's been such a reluctance to put money in the international space because of the outperformance of the S&P. I think there's a lot of opportunity there going forward if some of these trends can continue. One other area is small cap. Now, small cap is kind of a double-edged sword here, because not only is it cheap versus large, but if you do run into significant economic headwinds and or a recessionary environment, small cap could have a little bit more volatility than some of the more defensive large cap names. But in relation to valuation, again, very cheap right now versus the S&P 500. So again, this is a ratio chart. The higher the line here, the more expensive the S&P 500 is against small cap. We're looking at it right around a 20-year high And then we've started to have a little bit of a roll here. And, what happened when we were at these levels the last time? Well, here is small cap against the S&P 500. So when this line's moving up, it means small caps outperforming the S&P 500. So the last time we saw valuations like this, you had a sustained period, almost a decade, of small cap outperformance versus large cap companies. So where does that leave us from a portfolio positioning standpoint going into next year? So as we mentioned, we still believe that value, small cap, and international are going to offer the most opportunity, and we've begun to position portfolios accordingly. We just recently added some more money to our international exposure. We still have a value overweight, and we added some money back to small cap in both June and October of last year, our tactical portfolios. And we think if the Fed keeps their word and maintains a higher for longer stance, that those areas should continue to benefit from that. Now, we do recognize that 2023 has started against that view. You've had rates moving lower. You've had growth be the leader, while value, specifically defensive value, has lagged a little bit. So it's been a market move that has been more risk on. But as I think Casey mentioned earlier, we're not 100% convinced that is the trend that's going to continue. So the data on recession, I think, remains mixed going into the heart of earnings season. Employment remains strong despite some softening of economic data. And that's kind of led us to maintain a neutral exposure to stocks. If the data continues to be good, we could see a scenario where maybe we let those exposures run a little bit. And on the flip side of that, if we do start to see some significant recessionary pressures, it may cause us to look at becoming more defensive, either through positioning or possibly reducing equities. But again, we don't see the conditions there that would warrant that move at this time. So on the fixed income side, we're maintaining high cash levels as yields remain attractive, and we think those will increase slightly as the Fed again probably has another 0.25% to 0.5% to raise rates before they stop. But again, core bonds could provide some protection if we get into a recessionary environment. And this year, we've already seen rates moving lower, and bond returns for the ag this year, I think, are a little bit north of 3%. And most of that's already is just price movement because you haven't had the income component kicked in there as well. So we're trying to maintain a diversification throughout our fixed income with high levels of cash. Maintaining those, I think, is appropriate for now as rates are paying us to be patient there. And then I would say our base case for 2023 right now is that higher rates are eventually going to cause the economy to slow sometime in the middle of the back half of the year. And I think the big question is, what is the extent of that slowdown? And ultimately, that's largely going to determine what stock allocations for us are going to look like throughout 2023. So I know we had a few questions coming in during the presentation, so let's go ahead and address those right now. First question: if interest rates are stabilizing our bond prices, and if they are, if interest rates are stabilizing our bond prices, which have been beaten down due to rising rates, at a good buy point. So I think it really depends on how you look at the overall macro environment going forward. So I think the short answer to that is they're offering much more value than they did at the beginning of last year. You've had some significant resets and rates moving higher. To give you an example of what could cause the 10-year, the Barclays Ag, which again is the S&P 500 for bonds, last year was down 13%, really bad year. So where would rates have to go to on a 10-year to get that number again? Well, if you do some simple math, and I put a duration chart in the last presentation that my colleague said we should just skip over that, and hopefully people will look at it on their own time, would show you that 10-year rates would have to get north of 5.5% to cause returns like we saw last year in the bond market. So right now, the 10-year is roughly 3.5. So that's going to take a pretty significant move. Not that it couldn't happen, but I think you'd have to have the combination of very strong economic growth combined with inflation staying extremely elevated in order to have that happen. So I don't foresee that scenario playing out this year. So I think some areas of the bond market could offer some value. But as Casey mentioned earlier, it's hard to ignore the fact that, you know, cash rates are paying more than owning core duration bonds, you know, and in some instances by, you know, almost 1%. So I think, you know, when looking at fixed income, it's important to remain diversified across a few different, you know, outcomes, so to speak. But, you know, it's also hard to I guess, make the case for not owning a significant amount of cash with rates the way they are, and some of the psychology playing into what happened last year. Case, Dan, anything to add to that?
Yeah, I mean, another good thing, I guess, on the bond front is we've gone 10 plus years of you could barely get much of an interest rate on bonds. And last year, so we've kind of got a foot in both camps. We've got a foot in the camp of some in short-term bonds and in money market right now that's paying north of 4. But then also we took some dollars and went out and locked those dollars up. And when you look at 2025, 2027, both in treasuries and corporate bonds treasuries were paying over 4, and corporate bonds that were paying in the mid 5s, to take advantage of finally, as a bond investor, getting a reasonable rate of return on your money. So we certainly want to take advantage of that. And a lot of it's going to depend on what happens with the economy from here. I mean, if we get a soft landing and the economy starts to tick off, rates are likely heading up. And Doug mentioned that may be some duration risk. If we head more to the camp of more of a potential of a recession, then certainly we could see rates potentially come down some. And again, that can be good for bonds. So as Doug mentioned, we're diversified in those areas, but I want to make the point that, hey, we've taken advantage of bonds, given how beat up they were, to lock up some pretty good returns now looking out in the future. But it's what we'll continue to navigate and make decisions based upon how things continue to play out in the coming quarters.
Another question. So back on slide 4 or 5, you showed 5 years with double-digit losses followed by the next year double-digit increases. Did the Fed raise the rates anymore? Did they lower them to help the market during that year? So that's a very good question.
Yeah, it's a great question.
So let me try to
go back to that page.
Rip back to that slide as quickly as I can. So I think this is the slide that we're talking about here. Yep. So I have to be completely honest with you. I would have to check on some of the earlier years, specifically 37 and 74. I know 2002 and then 2008, the Fed was actively lowering rates. And they did that not necessarily in response to the economy, but more in response to the market. And I think the other thing is that the Fed has probably been more reactionary to market conditions recently than they have, earlier in history. So I guess I'm assuming the takeaway there is, if we don't have the Fed lowering rates into that environment, is it reasonable to think that we, could see these types of returns? Or, another way to put that, did the Fed lowering rates kind of juice these returns a little bit? It's a very good question. I know, like I said, in the 2002, 2008 area, I would say yes. The earlier years, I would have to look. The market's certainly pricing in that we're going to see rate cuts of 200 basis points over the next year or two. So some of that could be playing into this. But I would certainly have to follow up with the data from earlier years, because I just don't have that off the top of my head.
Well, and part of it may be what happens in the future going forward. So in an 02 and an 08, they were cutting and certainly not increasing rates, and certainly they were Fed friendly at that point in time. But it was because there was a lot of economic damage. So part of it's going to be how do things play out in the coming quarters from the economic side. Again, if you do have a soft landing and you start to see a rebound in earnings at that point in time, and valuations are reasonable, certainly it could be prime for a good return environment. Would that be north of 20? Maybe not that high from that standpoint, but certainly still could be. You've got the Fed on your side once the Fed stops at that point in time, and it still could be prime for a good environment. But at that stage, in a lot of those environments, they were cutting because there was a lot of damage. Now we're dealing with a different type of animal here.
Yeah. And then last of the questions that we had, kind of a few different areas. I think we touched on the expectation of what the Fed's going to do going forward. We had another question about oil and gas stocks specifically. I think energy is poised to still be a solid performer. I mean, oil remains around $80 a barrel, and outside a recession, you're probably going to see it remain close to those levels. Energy companies I don't want to say they can print money with oil at those prices, but they can create a pretty significant cash flow there. So I think they may not offer the returns that they did at the beginning of this cycle, but still a good place to look for dividends and cash flow. And then I think the last portion of it, and Casey, you may have the exact numbers here, but it was a question of, are we going to see S&P 3,700 or 4,500 first?
Wow, that's a great question, because certainly, a lot of the debate, and when we would do these webinars last year, is, we've always cautioned to say the bottom is in, and we've seen the bottom, and hopefully, if this data that we've seen recently continues to strengthen, hopefully the probability is that we're looking at the higher number versus the lower number. But unfortunately, it's not like we're in inning 8 or 9 probably of this ball game. So we probably got more innings, from a baseball analogy, more innings to play out, I think, before I think we can comfortably say which way we're likely headed on that. At this stage, certainly we're not positioned on the downside, feeling like we need to reduce equity exposure and be defensive, which is a good thing. But certainly we're not looking to load the wagons up at this point on equities and take on more risks. So I apologize. I know sometimes it's you want a little bit more meat on where things are going to go on that. But certainly if we need to manage risk and make changes in the portfolio, certainly we will do that, dictated by data. But certainly lately we've had some promising data, a little concerning on some of the deterioration on some of the economic data. But the labor market has been extremely strong, which has been good to see and continues to be. And other data points have been decent. So unfortunately, it's a to be continued.
Yeah, I think the best answer to that question, are we going to see 3,700 first or 4,500 first? I think the answer is yes.
Yeah. Yes. And I know there was one other question related around preferreds. If preferreds can be very sensitive, like bonds, to interest rates, and they generally can be a little bit of heavy on the financial side as well. So if those may perform okay if we have a soft landing or things don't deteriorate too much in the economy, they may hold up. But because of the dependency with financials, certainly they could take a hit if either interest rates are too strong or if we have too much deterioration. The other aspect of it, I would just caution on that front too, is sometimes preferreds you have to watch out for liquidity issues sometimes when you buy preferreds. So that's the only other aspect of when you have a lot of people looking to buy or sell them. They can move quickly from a market standpoint. Oftentimes there's just not a lot of liquidity with those securities. So you have to tread lightly in those areas sometimes. Well, lastly, guys, any other questions that we've had come up? All right.
Nope.
Well, again, a hooday here. We hope that people will be smiling, not only because of the market, because of the Bengals here. And thank you for the trust and confidence you placed in HCM. I know these have been challenging times and frustrating sometimes as well with this market downturn, and it's This is the longest downturn we've seen in more than a decade. So please don't hesitate to reach out if you'd like to discuss your individual plan. We're glad to help. If there's a family member or friend we can help, please don't hesitate to reach out to provide an introduction. We would be honored. Thank you and have a great night.